Welcome to Breaking News to Trading Moves. We're starting today with a headline that's definitely caught attention in the Asian banking world. We're talking about HSBC moving to fully acquire its Hong Kong affiliate, Hang Seng Bank. That's a pretty substantial corporate action.
It really is. And when something like this happens, our aim is always to, well, quickly get to the facts, figure out which companies, which sectors might benefit, and conversely, which might face some near-term headwinds based on the analysis we have.
Okay, let's lay out the specifics then. The materials put the deal size at roughly HK $290 billion.
That's right, which works out to about 37 billion US dollars. A significant amount.
And the price offered to Hang Seng shareholders.
HK $155 per share. And if you look at where the stock was trading before this news broke, that's a premium of, let's say, around 30 to 33%.
Wow, 33%. That's a serious premium.
It signals real commitment.
Especially since, HSBC already owned a big chunk, didn't they? Something like 63%.
Yeah, exactly, around 63%. So this move is about consolidating control, buying out that remaining minority stake.
So why now? What's the thinking behind taking full control, particularly given, as the material notes, Hang Seng has somewhat elevated impaired loans, about 6.7%.
Well, the read is that it's a strategic move, a signal of long-term belief in Hong Kong's banking system. Despite those current credit challenges you mentioned, they're essentially doubling down.
Doubling down, but that comes at a cost, right? A cash deal this big must have an immediate impact on HSBC itself.
Absolutely. That's the immediate trade-off. Paying cash hits HSBC's capital position straight away. We're looking at their CET1 ratio. That's a common equity tier 1, a key measure of capital strength. It's expected to drop by about 125 basis points because of this.
Oof, 125 basis points. That's not insignificant in regulatory terms. So what's the direct fallout from needing to absorb that hit?
The immediate consequence is that HSBC has to pause its share buyback program. They need to rebuild that capital buffer.
Okay. So even if it's a good long-term strategic move for them.
In the near term, yes. The designation for HSBC, ticker HSBC, is one of pressure. It's about absorbing that capital cost and, well, the usual complexities of integrating such a large piece.
All right, that paints the picture for HSBC. Near-term pressure to digest the deal. So if HSBC is taking this on, who stands to benefit from this sort of vote of confidence in the Hong Kong system? Let's look at winners.
Yeah.
First group mentioned, China and Hong Kong Internet ADRs, specifically Alibaba, BA, and JD.com, JDD.
Yeah, the thinking here is partly about sentiment, but it has real effects. When a global heavyweight like HSBC makes such a large financial commitment to Hong Kong, it can help ease some of the generalized risk perception that investors might attach to China and Hong Kong assets overall.
So just to clarify, you're saying a bank deal in Hong Kong could actually reduce the perceived risk for, say, e-commerce companies like Alibaba or JD.
It sounds broad, but the mechanism makes sense. A more stable, confidently backed financial system supports the underlying economy. That means potentially more stable consumer activity, better conditions for merchants, the very things these platforms rely on. Lower perceived risk can help their valuations.
Got it. Okay, moving on. Second group identified as potential winners, U.S. investment banks. The ones with strong Asia-Pacific operations, like Goldman Sachs, GS, and Morgan Stanley, MS.
Yes, this is more direct. Large-scale bank consolidation like this isn't just a simple purchase. It sets off a chain of other financial activities.
What kind of activities?
Things like arranging funding for the deal itself, sophisticated hedging strategies to manage risks, maybe capital markets work if there's restructuring.
And potential disposals, too, if they need to streamline.
Exactly, potential disposals as well. All of this activity generates fees for advisory work, for markets division. So for banks like GS and MS with boots on the ground in Asia, this kind of deal is, well, good for business. It feeds their pipeline.
Right, the complexity itself creates revenue opportunities for them. Okay, final winner group, indexes, ratings, and data platforms. The names mentioned are MSCI, that's MSSCI, and S&P Global SPGI. Why would they benefit?
This is about the mechanics of the market. When a major company undergoes a big structural change like an acquisition, restructuring, significant capital shifts, especially a large financial institution, index providers have to react. They need to recalculate weights, potentially reclassify things. It triggers mandatory adjustments across countless funds and portfolios that track those indexes.
Ah, so it forces trading and rebalancing based on their indices.
Precisely. And that forced activity drives demand for their data, their analytics. Rating agencies also get involved assessing the new structure, the credit implications. So these corporate actions mean more work, more data usage, more demand for ratings and benchmark services related to Asian financials. It's built-in business for MSCI and SPGI.
Okay, clear wins across tech platforms, investment banking, and data infrastructure. Now let's look at the other side. Which areas might face some pressure related to this? First up, maybe a less obvious one. China construction link U.S. cyclicals. Names like Caterpillar, CAT, and Freeport-McMoRan, FCX, the copper producer.
Yeah, the connection here is about the context of the HSBC deal. Remember those elevated impaired loans at Hang Seng we mentioned?
Right, linked to property stress.
Exactly. The deal is happening against a backdrop of known stress in the property markets in both Hong Kong and mainland China. And if that underlying credit situation, particularly in construction and property, remains slow to improve, well, that can put a lid on demand for certain things.
Like heavy equipment from Caterpillar or copper from Freeport.
That's the suggested link. If regional credit repair is sluggish, the demand for construction machinery and industrial metals like copper might stay capped. It ties back to that broader economic picture in the region.
Understood. So the final group potentially facing headwinds. U.S. financials with significant exposure to Asia, specifically in retail banking or insurance. The examples given are Citigroup, ticker C, and AIG, ticker AIG.
Here, it's less about direct capital impact, like with HSBC, and more about investor perception, specifically the perception of the quality of earnings coming from the region.
Meaning, if there are lingering concerns about credit costs in Asia.
Investors might apply a higher discount rate or just be more cautious about valuing the earnings generated by those Asian retail or insurance operations.
So until there's more clarity that credit costs in the region are normalizing back to expected levels.
Yeah, companies like Citi or AIG, where Asia is a notable part of their growth story, might see investors taking a bit of a wait-and-see approach regarding the value of those regional earnings.
Okay, let me try to quickly recap for you. HSBC makes a major move, acquiring the rest of Hang Seng Bank, a $37 billion cash deal. This puts near-term pressure on HSBC's capital, pausing their buybacks. On the flip side, the analysis suggests potential beneficiaries include China HK tech ADRs like BA, and JD, U.S. investment banks like GS and MS involved in deal flow, and data index providers like MSCI and SPGI. Meanwhile, potential pressure points are seen for U.S. cyclicals tied to China construction, like CAT and FCX, and U.S. financials with Asia retail insurance exposure, like C and AIG, due to ongoing credit concerns.
That sums it up well, and maybe one final thought to leave you with. This whole deal forced HSBC to pause buybacks because of that 125 basis point capital hit. Think about what that implies. How sensitive are markets and regulators to these capital buffers right now, and how quickly might banks need to act, maybe through capital markets, to rebuild such buffers after major deals? It could influence how other global banks approach M&A going forward.
That's a good point to consider. And finally, just a necessary reminder for everyone listening. This discussion, including identifying winners and losers, is based purely on the opinions expressed in the material we reviewed today. It is absolutely not financial advice. It's not a recommendation to buy or sell any specific security. The tickers we mentioned were BA, JD, GS, MS, MSCI, SPGI, HSBC, CAT, FCX, C, and AIG. Please do your own research.